Ladies and gentlemen, welcome to the second Praxis Roundtable hosted by the World Bank in Sydney in partnership with The Diplomat magazine. My name's Ian Gerard and I'm editor of The Diplomat. I'd also like to extend a welcome to everyone watching us on APAC at home, also over the internet, or listening to us on radio across the Asia-Pacific region. Today's topic for discussion is the global financial crisis, and to give us their thoughts are Vikram Nehru, who is chief economist in the East Asia region of the World Bank, Mark Thirlwell, who is Director of the International Economy Programme at the Lowy Institute, and Tim Harcourt, the self-styled airport economist and official chief economist of the Australian Trade Commission. The GFC has been called the perfect storm as far as the Asia-Pacific is concerned. In global terms, it's been called everything from a cataclysm of capitalism to an act of God. Kevin Rudd has laid the blame for the crisis on free market fundamentalism, while in one of his last pronouncements, George W. Bush claimed that it is not the result of market failure. Currently, of course, the various government stimulus packages are receiving widespread coverage. The $42 billion here, the $1.2 trillion in the US. And today we'll certainly be touching on how Australia and the rest of the developed world has been affected and is still being affected by the GFC. But the main aim of these roundtables is to look at how crucial global issues are impacting on developing nations. David Kinley of the University of Sydney believes that the most dramatic effects of the GFC will be seen in the poorest, least developed states, simply as he puts it, because they have less to lose. The World Bank statistics support that view. An estimated 53 million people in developed countries will be trapped in poverty this year. There will be up to 400,000 extra infant deaths each year to 2015, and investment growth in the developing world is expected to fall to 3.5% in 2009, down from 13% 2 years ago. At last year's APEC meeting in Peru, the region's leaders were united in their opposition to protectionism. Whether they maintain that stance in the face of intense domestic pressure, of course, remains to be seen. Indonesia's trade minister has already said that some protectionist measures are inevitable in the coming year or two, and a recent New York Times article argues that the protections for domestic companies included in a number of international stimulus packages increases the likelihood of protectionist trade battles. In this latest issue of The Diplomat magazine, Tim Costello of World Vision raises concerns about governmental priorities in the first world since the credit crunch first struck. So a question would be, will foreign aid to and investment in developing countries be one of the major casualties of the GFC? That's a question that our panellists may like to address later on, or answer a bit later on. And once we've heard from each of them, I'm going to invite questions from the room here today. And please don't be afraid to make those questions tricky ones or to challenge any points you don't agree with. The whole point of the roundtables is to stimulate debate and to share new ideas. I'd like to introduce our first speaker now. It's Vikram Nehru. He's been with the World Bank since 1981 and has worked in several capacities and on a number of countries, including Indonesia, Nigeria, Ghana, Malaysia, and China. Now Director for Poverty Reduction, Economic Management and Private and Financial Sector Development, as well as Chief Economist in the East Asia region of the World Bank. He is well qualified to discuss the impact of the financial crisis in a regional context and to examine the outlook for East Asia and the Pacific region over the coming year. Vikram.
Well, thank you very much, Ian, and welcome to all of you as well. It's fallen upon me to actually talk initially a little bit about the depths of the global financial crisis. And I guess the only way to describe it is that for the first time when we talk about financial crisis, we're actually talking in terms of trillions, no longer in terms of billions of dollars. And that certainly is a change in the parlance that we use in international economics. Just to give you some numbers, in the United States, where the crisis originated, the deterioration in U.S.-originated assets is about $2 trillion. That's a loss in asset value that's taken place in U.S.-originated assets. Something like 39 banks have now gone under. There has been an enormous, unprecedented set of interventions which the U.S. Federal Reserve as well as the U.S. Treasury have initiated. Just to give you some numbers again, enormous numbers. $1.2 trillion of liquidity that's been pumped into the system. There have been 318 financial institutions which have now received capital injections under the Troubled Assets Relief Program, the TARP as it's called. Some $5.5 trillion worth of of guarantees have been provided, again, by the US Fed, the bulk of which have gone to Freddie Mac and Fannie Mae. And lastly, just in 2008 alone, there was some 32% increase in corporate filings of bankruptcy. And in 2009, that's likely to increase further. So this really is a problem of cataclysmic proportions, and certainly the problem has spread all over the world. In Europe, things could perhaps even be worse for the simple reason that the banking sectors in Europe in relation to the economies of Europe are far larger. They had a high exposure to toxic assets. They started off with higher levels of debt, so they have less room for maneuver. So, and they have a significant exposure to Eastern European countries, where some of the crisis is turning out to be particularly severe, and secondarily as well to Latin America. So Europe, Western Europe, is also being hit particularly hard. Now, the projected output loss globally is the greatest since the Second World War, since the end of the Second World War. And that's certainly the case as well for the advanced countries. All the advanced countries are currently in recession, the US, the Eurozone, as well as Japan. And overall, we expect that global growth this year will either be zero or perhaps slightly negative, which is for the first time this has ever happened. Not just trade contracting, but actually output contracting worldwide. In the United States, layoffs in 2008 were 2.6 million, which is the highest they've ever been since 1945. So this is truly an amazing time. It's an amazing time to see this happen, and it's also quite amazing to see how this crisis has transmitted itself to the developing world. From the East Asian perspective, this crisis has arrived in three phases. The first phase is, in a sense, almost done, and it's the financial turmoil phase. It's the phase in which capital has been withdrawn from East Asian countries in enormous amounts. By the way, when I talk about East Asia, I'm referring to developing East Asia, which is the middle-income countries of East Asia as well as the low-income countries of East Asia. So there's been an enormous withdrawal of liquidity and capital from the middle-income countries. These countries have now found it virtually impossible to raise any capital from outside, from the international capital markets. The premia for borrowing have increased astronomically. And as a result, there's an enormous shortage of dollar liquidity. But these countries have responded remarkably quickly, and I suspect the reason they've done so is because the memories of 1998 are still very fresh in their minds. So their policy responses have been very quick, have been comprehensive, have been quite impressive. These countries are now undergoing a far more difficult phase of the crisis. They're now having to deal with the collapse of global aggregate demand. So exports are beginning to fall very sharply. In many countries, exports have gone down by double digits. In some countries, it's in January, the decline in exports is of the order of 40%, which is absolutely something that's never been seen before. In China, in January, the decline in exports was 17.5%, which for a powerhouse like China really does say something, although some people do argue that the decline in Chinese exports in January is partly due to the fact of the timing of the Lunar New Year. So that might have had something to do with it, but nevertheless, this is an important development. And now we're entering into the sort of third phase of the crisis, in the sense that because of the large amounts of unemployment and layoffs in the industrial world, we are likely to see a decline in remittances. Now, so far, remittances have been the most resilient form of capital flows to developing countries. And in the absence of any other form of capital flow, the sharp reduction or in some cases reversal of capital flows, many countries which rely on remittances are going to find that even these are going to be affected. We don't know by how much, but if Mexico is any indication, it could be very substantial. Now, just a little glance at the future. I'm not a great believer in projections of growth, but our expectation is that in 2009, East Asia could be expected to grow by anywhere between 5 to 6% in aggregate. Now, in a situation where the world economy is, in aggregate, going to contract, 5 to 6% growth by East Asia is still pretty good. And indeed would be the envy of many other parts of the world. And so East Asia is now, hopefully, will act as a pole, a growth pole for the world economy. Hopefully it will be a part of the world which will pull along the rest of the global economy, even as the really large economies of the world, the United States, the Eurozone and Japan, are going to find it extremely difficult over the next 12 months. So let me stop there. I think my time is out, but thank you very much for that.
Thank you, Vikram. We'll turn to Mark Thirlwell now. Mark's currently Director of the International Economy Programme at the Lowy Institute, and he previously worked as an economist for EFIC, JP Morgan and the Bank of England. I'd be interested to hear whether he picks up on any of Vikram's points, as well as talking about the near-term consequences for growth and trade and the longer-term implications for the regional economy. Mark.
Thanks, Ian, and thanks to everybody for turning up and coming to listen to us. Starting off on the short-term consequences, I mean, Vikram, I think, has done a really good job of summarising everything there, but just to quickly run through, I mean, where we're at, both the trade cycle and the financial cycle have kicked sharply into reverse, and we're seeing that has pretty painful consequences for developing countries, whether they're in emerging Europe, which is in the process of restaging its own version of the 97-98 financial crisis. Large current account deficits, what were overvalued exchange rates, and lots of foreign currency borrowing, much of which wasn't hedged. So, proving the adage that we learn nothing from history, so we're going to have a rerun. Through to East Asia, which in 97-98 had a capital account crisis, and which this year is having a current account crisis. So then the transmission shock was mainly through financial flows. This time it's through the collapse in trade flows that Vikram has talked about. And basically what we're seeing, and it's quite striking, the buzzword used to be globalization. The new buzzword, if you look in the current edition of The Economist, and I think it was floating around the FT over the past week, is deglobalization. So we're seeing the unwinding of international trade flows and the shrinking of international capital flows. The IIF, the Institute for International Finance, for example, on its back-of-the-envelope calculations, thinks that private capital flows to emerging markets this year will be 82% less than their peak year of 2007. We've seen, as Vikram mentioned, trade contractions, 20, 30, 40% year-on-year falls in recent months across East Asia. And we're seeing pressure on migrant labour as well. More, I think, you'd expect to see this happen in a global downturn, although the scale of it is pretty stunning. Also worrying, though, is that we're also seeing policy-assisted deglobalization, and we're seeing three kinds of this. Firstly, we're seeing sort of the local content provisions. This is the Buy American and Hire American provisions in the recent US stimulus. Many of the West European and the Northern European countries are doing something similar. So we're seeing this idea that if you're doing fiscal stimulus, the benefits of taxpayers' money should be kept within national borders and not allowed to leak out. We're seeing what is now increasingly being called financial mercantilism. That's the pressure on banks which have received public funds to withdraw from international markets and to keep that money at home. And again, there's a political logic to this. If you pump taxpayers' money into a bank, the money, in theory, is supposed to be being lent back to your country, not being sent overseas. And we're seeing, for example, the British Jobs for British Workers calls, similar in France, where the French government said if we're pumping money into the French auto industry, we don't want to see any new factories being opened in the Czech Republic. This sense that, again, that employment should be, the focus on employment should be within national borders. The consequences of both deglobalization and this policy-assisted version and the crisis itself, slowdown in growth, increase in poverty, increase in unemployment. Unambiguously bad for development, unambiguously bad for developing countries. If you are looking for any silver linings in all of this gloom, I guess one of them is that if you think back about a year, developing countries were worried about, a big subset of developing countries were worried about very high commodity prices. It was good news for developing country commodity exporters, bad news for importers, particularly if you're a food importer, but also if you're very energy dependent. So the one silver lining for some of this is those import bills have gone down somewhat. But for those developing countries that have won from that, there are developing country exporters that have lost. So if the short run is really grim, what about the longer term? The longer term, I think, is up for grabs in a way that it hasn't been for a very long time. We've had, I would argue, a period that actually has been very good for the emerging world and for developing countries. There's been lots of downsides to the way the world economy has run recently, volatile capital flows being an obvious one, dealing with commodity spikes. But by and large, if you look at developing country growth rates over the past decade, they've been pretty good. depending on what sort of structural changes this crisis does to the world economy, we can't assume that we get back to that same kind of growth process going forward. So if we're moving to a world economy where there is much more skepticism about globalization, if there are more policy initiatives aimed at throwing grit in the wheels of globalization, if you like, if there is an increasing tendency to return back to national regulation, putting your own nationals first, as part of the sort of the return of the state, and if we're sort of also ending for a period of financial retrenchment, so where it's going to be much harder for international capital to flow as easily across international borders as it has in the past, then it's possible that the great convergence, that increase in economic growth that we saw developing countries benefit from over the past decade, might not be with us going forward. And I think that's the biggest risk that I can see for developing countries going forward. Now, I'm an optimist. I actually think that when this crisis plays through, we will get back onto that great convergence path. We will see there's still a huge amount of potential growth left in the world of developing countries, and that will be activated again, but I think the risks to that not happening are greater now than they have been in at least a decade, and probably well beyond that.
Lovely. Thank you, Mark. And finally, it's the turn of Tim Harcourt. As I mentioned earlier, he is Chief Economist of Austrade, and his role is to analyse the global economy to help Australian exporters and to devise international business strategies. I'm sure many of you in the room receive Tim's regular email blogs and bulletins, and he must be one of the few economists anywhere who can tie the film Sex and the City to Australia's current export situation. Today, however, Tim is going to focus on the impact of the global crisis on trade and economic development, and particularly how this will affect Australia and the Asia Pacific. Tim.
Well, thanks, Ian, and it's a delight to be here with the World Bank, with my esteemed colleagues. I've got to say that since the GFC, as it's known in Australia, has started, the demand for economists has increased, particularly airport economists that fly around. And some of you may be asking, is Keynes dead? I think John Maynard Keynes himself passed away in the late 1940s, but certainly the ideas of Keynes and the ideas of non-conventional economists are pretty much making a comeback, and economics is back on the front pages instead of climate change and terrorism. But I'll say this today. First of all, I wanted to talk a little bit about the impact of the GFC on trade and investment and how that related to Australia and particularly to our neighbours in the Pacific in this region. With respect to the GFC, 12 months ago, I was in this room with Stephen Roach talking about Asian decoupling, and in the region we were talking about supply side constraints. And the debate was, as the credit crunch in the US went from Wall Street to Main Street, whether Asia would be immune. Now, 12 months on, as the commentary has gone from the subprime to the ridiculous, we have our answer from Vikram. No country is immune and no region is immune, and the large falls in exports, as Vikram mentioned, are a very important part of that story, particularly in East Asia in the last quarter. But the important thing to remember is that trade is actually a victim of the GFC. It's not the cause of it. And for that reason, I think trade will play a very important part in recovery. And we know from Mark Thirlwell's work that global trade since 1950 has grown 3 times as fast as global output, and Australia, of course, has been very active at the WTO level in the Pacific and also within ASEAN and across into Latin America with Chile. This is very important. It's very important that all countries of the world continue the momentum for trade liberalisation, particularly for developing countries. We all know that trade liberalisation has been the best engine that we've had to enable developing economies to grow and to reduce poverty. There are some fears, as Mark said, about protectionist impulses, particularly in the US Congress. When Barack Obama was elected in November, in that historic moment, Rupert Murdoch was quick off the mark to claim that a Democratic president is always protectionist. But we know that President Obama has free trade-minded economic advisors. 68% of American economists voted for Obama, and he himself, being an internationalist, I think has actually given out some very good messages on protection. The visit of Secretary of State Hillary Clinton to the region, to a rich country like Japan and a traditionally poor country like Indonesia, is a good sign that the US wants to engage in the region. Whether she lifts the boycott on Cuban cigars, I don't know, but her commitment to Asia is important. Another fear for developing countries is also the prospects of an FDI recession. We know that there's been a 31% fall in FDI due to the GFC, according to our good friends at the World Bank. We know this could be difficult, but we also know this provides an opportunity for countries, particularly in our region, to basically change their regulatory regimes to become more attractive to FDI. And indeed, we're seeing outward FDI from the region, including China, now playing an important role in developed countries like Australia. There is a related issue of trade finance. Partially, this is due to the reduction in demand, but I think that means that improvements in regulatory regimes will be very important as all countries have to reduce their risk premiums. Now, how important is this crisis for Australia, and how important is it for the region, particularly in the Pacific? Well, no country is immune. We know from Vikram's data there's been a collapse in trade in East Asia. In Australia, all our trading partners will now grow less than 2%, and this has been the most synchronised downturn in our trading partners since the 1970s. But I think in some ways, while Australia is not immune, and it should be alert, not alarmed, there are some reasons why Australia and New Zealand, where I've just come from, will do reasonably well in absorbing the GFC and in preparing for recovery. Why? The reforms that we've undertaken domestically, the float of the exchange rate, what we've done to our banking system, being committed to openness, and also playing very important roles to have strong social safety nets. We're very much part of this region. The tyranny of distance has been replaced by the power of proximity, and indeed the Pacific will be very important to recovery. In the Pacific, there are more Australian exporters selling to the nations of New Zealand, Papua New Guinea and Fiji than a lot of the rest of the world. Almost as many exporters go to Papua New Guinea as to China, and almost as many to Fiji as Japan. So I believe that the Australian government and Austrade's commitment to the Pacific is very important. We've had very senior people going to Port Moresby, and I myself will be there next month. Now, in terms of response, what's the most important thing? Well, I think there's four things. Firstly, a commitment to trade liberalisation. The WTO is not as dead as a Doha. We need to keep up momentum. Australian Trade Minister has said we're 80% of the way there, and we need to maintain that momentum. Secondly, fiscal stimulus and accommodating monetary policy must be given time to work, and the early signs are good. And finally, it's very important that we have social safety nets and labour market institutions, and that we avoid beggar thy neighbour trade and exchange rate policies. Institutional reform will be important, but like Mark, I actually think that in recovery, we'll find that institutional reform will actually make us stronger. Thank you.
Lovely. Thank you very much, Tim. Before we move on to questions, I'd just like to follow up one of the points you made. You said that trade is a victim of the GFC. I saw a report today that Trade Minister Simon Crean has linked Chinese investment in Australian mining to a trade deal between the two countries. Wouldn't that be sort of exacerbating, potentially, the effects of it and sort of contributing to it rather than being a victim of it?
I think in many ways economic relationships with different countries expand into the investment arena. One important study by John Edwards for CETA here in Australia showed that most of the growth of outward investment now exceeds inward investment in Australia, which has traditionally not been the case in our history. And that's actually in some ways become more important than trade. And the Diplomat's own study showed that outward investment by Australian companies were becoming as important as exports. I think for the most part, with foreign direct investment within Australia, a lot of nations in the region have actually been very successful. India, for instance, has undertaken very significant foreign direct investment into Australia, not just in mining, but in pharmaceuticals and healthcare. And I think China's making that transition from having basically government-owned enterprises making these decisions to commercial decisions as has occurred with Indian enterprises.
Do we have any questions from our studio audience here? Yes, please. Before you, when you ask your question, if you could just say your name and which organisation you're representing, that would be very helpful.
My name's Zelda Anthony and I'm from Swift. My question is, well, I've actually got two questions. Is it just another economic cycle or is this crisis different? And the question everyone's wondering, how long do you think it will last?
Mark, maybe you could field that one first.
Okay.
Sorry.
No, that's good. Yeah, this one is different, just in terms of its sheer scale, and in terms of the policy responses as well. I mean, if you look at the sort of policy responses we've had, we now have zero interest rates effectively in the United States. That's the first time the Fed has done that in its history, in about 95 years. The Bank of England has its bank rate down to the lowest in its something like 315-year history. Japan, of course, is back at zero, but that we don't have to go so far back for the lost decade we saw there. But also the policy responses to the banking crisis. I mean, we now have large chunks of the British banking system have been nationalised. The Americans in the US are being dragged kicking and screaming towards nationalisation. In fact, we've had a partial kind of nationalisation already, but then in terms of sort of formal nationalisation, that's getting closer and closer, I think, when they're desperately trying to resist it, but they're sliding towards it. So in terms of the depth of the downturn, the breadth of the downturn, in terms of the way it's brought pretty much the whole world economy down with it, and in terms of the policy response, it's very different, I think, than anything we've seen in the post-war period. There's always two temptations whenever you're in the midst of a crisis. One is to underinterpret, to sort of say, well, everything will go back to being normal afterwards, and the other is to overinterpret, to say everything changes this time. I think the danger of doing the underinterpreting is now gone. The risk is that, if anything, there's a temptation maybe to overinterpret because of the magnitude, but I think it is all different. In terms of what's the turning point, I don't think anybody knows, is the honest answer to that one. Basically, people are revising their forecast on a monthly basis at the moment. So no forecast is really worth the paper it's written on right now. So basically, I think what this boils down to at the moment is whether you are an optimist or a pessimist. I'm a congenital optimist. I hope, and I stress the hope, that by we're getting through 2010, we'll start to see recovery kick in. It won't be kicking in everywhere by any means, but we'll start to see some of the more robust parts of the world coming out of it. But the risks to that optimistic take, I will happily concede, are all to the downside.
Tim, any thoughts on that as well?
Yes, it's a good swift question, first off the mark. I think two things. One is, I agree with Mark in the sense that it's very unusual to have such a synchronised downturn. And, 2 years ago, the IMF said this is as good as it gets. It's the best synchronised growth since the 1970s. Now we've got the effect in reverse. But what's different, I think, is that this is not some external shock. This is an internal institutional shock within the financial system, not the real economy. And secondly, the policy response has been very swift. Flash Gordon Brown, he basically took charge very early. When you saw in the US the difficulty of the Treasury Secretary, Hank Paulson, with the Congress and with the President, institutionally took a long time. A Westminster system in the UK saw Brown, act very quickly with respect to those financial issues, and I think that shows an institutional flexibility that Westminster had, and also it's probably good to have a dour Scottish banker in charge at a time like this. For Australia and New Zealand, and therefore the Pacific, I actually agree with Mark. I think that there are actually some good signs of recovery, given that monetary policy and fiscal policy were enacted quickly. I think we've got away from deficit fetishism, and I think the Reserve Bank here was very, very strong, and New Zealand's followed suit. So actually would be on the side of the optimists, but I think now it's about psychology more than economics.
Vikram, anything to add?
Yeah, there's a study done by some colleagues in the IMF who examined 122 recessions in OECD countries over the last 3 or 4 decades. And only 4 of those recessions had all of these 3 features: a housing bust, an equity bust, as well as a credit crunch. And those 4 were limited to a country here or a country there. So the combination of the fact that this is a synchronized crisis literally across the globe, there isn't a country that has escaped it, as well as the fact that it's all 3 housing, equity, and credit markets that have been affected, that make this a particularly serious case. So it's definitely not a cycle. How long will it last? Well, that same study showed that on average, for severe recessions, from peak to trough, the average is around 6 quarters. So if you simply assume that this is going to be an average severe recession, then we're talking about recovery in early 2010, because this started, roughly speaking, somewhere in mid-2008, if you start the downturn from that point. But this is unlikely to be an average severe recession. It's probably going to be a severe recession, and so it certainly might take longer. But I think the really interesting question is that even if there were to be recovery, what kind of growth would one see at the end when the recovery begins? And here there is, I think, in my view, a structural change that has taken place in the world economy. After all, when we went into this crisis, the big savers were East Asia and the Middle East, and the big consumers, the net big consumers, were the United States and Europe. But the United States and Europe can't and will not be able to continue levels of consumption that they'd enjoyed in the previous decade. That means that savings rates are going to have to increase there. And if global demand is going to return, it means savings rates elsewhere have to decline by as much. And the question is, where will they decline? Will East Asia start consuming a lot more than they've done in the past? And that's not an obvious yes, because this is wrapped up just as much in culture and policies and in mindsets of policymakers as it is in economics. So, somebody said this is a confidence question. Absolutely, that's. But once we get out of the crisis, it might actually become a cultural issue, actually, because the U.S. economy, incidentally, is 4 times as large as the Chinese economy, roughly 13.4 trillion versus 3.4 trillion. Sorry, 14.3 trillion versus 3.4 trillion. If the U.S. economy were to have a current account deficit which is 2 percentage points of GDP less than it has now, it means all of China's current account surplus would have to be wiped out. That's 8 percentage points of GDP for China. And I don't see that happening. So if global demand isn't going to come back, are we going to get growth at the same rate as we've enjoyed in the past? And I doubt it.
So regardless of when the recovery happens, be it in 6 quarters, 8 quarters, 10 quarters, 12 quarters, will it necessarily be slower to filter through to developing countries, particularly in the East Asia region? I mean, Mark said earlier he's quite optimistic about East Asia. I wonder if you share that, Vikram, if you share that optimism.
Well, again, I think it'll happen in phases. And the first phase, I dare say, is to my mind going to be a worrisome phase for East Asia. Because when credit markets begin to unfreeze and credit begins to flow, there is so much liquidity in the system now that when the money multiplier begins to work positively, according to me, there will be a very rapid expansion of credit because there's a large amount of unutilized capacity now in the world economy. Right? But if aggregate savings don't decline, it means savings will continue to be looking for high returns. And where will those high returns be found? To a very large extent, much of those high returns are still going to be found in many emerging markets. So my worry is that emerging markets will once again see a sharp increase in capital inflows. And we've known that if those capital inflows are not managed well, that's, they lead to exchange rate appreciation, and they lead to problems of bad investments, and eventually lead to another crisis, this time in the emerging market countries themselves. So I'm not sure whether the countries of the region, especially in East Asia, have the wherewithal, the capacity to deal with, once again, a very sharp increase in capital inflows, say 3 or 4 years down the road. And that worries me.
I have another question, please. Yes, at the back.
Hi, Jeff Weinstock from the Australian Financial Review. I just was interested if you could comment on, we just had the growth figures for, say, Japan, South Korea and Taiwan, where you've had falls in growth in those 3 countries, which are much bigger than in America and Europe, which is supposed to be the centre of the crisis. And I wonder if you could comment on that. And I have a suspicion it has, and I'm wondering if it has something to do with some sort of one-off inventory effect where they're just getting used to the idea that they can't export anymore, and if you agree with that, and how do you think that might play out?
Tim, I'll throw that one to you first.
Yeah, thanks for your question. There's 2 issues here. I suspect that you may be right with respect to inventories, but secondly, those 3 countries you mentioned are reasonably integrated in terms of global supply chains, and when you look at the trade data on East Asia, just published and also some of the intra-Asian trade data, it's reasonably consistent with those trends. I'll say a couple of things about Japan. One is we've looked in our own data and we find that there's still a significant number of companies over 3,500 exporting to Japan. From Australia, the numbers are holding up reasonably well, but there's very few companies actually based there. There's only 100 Australian companies with offices there. So I think people talk about, I guess, browbeating protection, but there's a bit of implicit protectionism behind the border that perhaps is something that Koizumi was trying to fix and lost a bit of momentum with some of the political changes in Japan. So I'd say for the most part, whilst with the industrial production slowing and therefore some impact on commodity prices, that's been factored in. But in the services and the consumer parts of the Japanese economy, the ageing of the population, running out of husbands and so on, a lot of that will actually have some impact too, but it'll probably hold up reasonably well in consumer markets.
Mark, anything to add?
I mean, it's partly because of the story of this phase of the crisis, which is the contraction in developed country demand and the big downturn in world trade. If you're running reasonably open economies, Japan's a partial exception to this story, but the Japan case was pretty much the external sector was where you still had growth and nowhere else, but certainly for Korea and Taiwan, and for even smaller and more open economies like the Singapore numbers we saw, for example, which were equally dramatic. Then when world trade contracts really sharply, you're going to suffer. And it's been one of the paradoxes of this has been that when you look at where have the big falls in growth been, they've been in the current account surplus countries with the exception of East Europe. So, for example, when you look across the euro area, which is the countries that had some of the biggest falls in GDP in the last quarter, well, Germany, which was the country everybody thought was the strongest European economy, saw a bigger contraction in its final quarter GDP than the UK did, which has been hit much more severely by the financial crisis in terms of its financial sector. So being a current account surplus country, being a country that is reliant on net exports as one of your engines of growth at a time when world trade is contracting sharply, means that you're going to suffer pretty dramatically. And I think, coming back to sort of Vikram's point about the region coming out of the crisis after this, I mean, there is an interesting medium-term question here about what the region's growth model is after this. The 97-98 crisis, the lessons that the region took from that were you have to be very wary of short-term capital inflows, and you have to be very wary of letting your exchange rate get overvalued. You should build up big war chests of foreign exchange reserves so that if there was a crisis, you had your own self-insurance, and you shouldn't touch the IMF with a punch pole if you could avoid it. Don't go near the Washington international institutions. Sorry to or sister institutions in this case. You don't want to be don't surrender your control to DC. A lesson which is probably being reinforced at the moment when they're looking at what some of the people who are pushing the advice in 97, 98, the Geithners and Summers who are now in the Obama administration, and the kind of policy input tools that they're applying in the United States that they're most simply were saying don't apply in East Asia in 97, 98. But so they sort of learned a lot of those lessons, and the lessons that they thought, well, okay, so we'll do lots of exporting, we'll build up current account surpluses. And then it turned out that gets you sideswiped as well, because when world trade collapses, then you're in trouble again. So it's time to it seems to me that it's time to go back to the drawing board one more time and reinvent the model again. You don't reinvent models quickly, so you don't shift. So that's, I guess, in terms of thinking about why you'd be cautious about growth projections going forward, it takes you time to reinvent models. But the region has been very good at reinventing itself, and I guess this is again where I tend to come down on the optimistic side, that I think they will reinvent the model one more time, and we will see growth return.
Yeah, Tim.
I was just going to add something. I mean, Mark made a very good point about the Asian financial crisis, because Stephen Grenville, the deputy head of the Reserve Bank, and Glenn Stevens to some extent took on the IMF on the case of Indonesia, basically because the advice that Indonesia was getting to basically cut government spending came exactly the wrong time. And I think to some extent we can learn from the Asian financial crisis for the reasons that Mark outlined, but also in terms of some of the institutional reforms that we've done in corporate governance and banking and finance. And in fact, the Reserve Bank itself has been a big exporter of financial advice since the Asian financial crisis. So Stephen Grenville lost a lot of skin in that fight, but it was actually worth it when you look at what's occurred to Indonesia since as one of the world's largest democracies.
Vikram, I know Indonesia's an area of special interest for you. Would you agree with that it was a fight that was worth fighting on behalf of the RBA?
I'm not going to comment on what the RBA did or didn't do, but I think the point that Mark just made is a very important one about reinventing. East Asia once again has to reinvent itself, and I think there is active effort right across the board. This is already happening. In China, for example, the $586 billion fiscal stimulus package. It's a very interesting effort to follow through on what's already a requirement under the 11th five-year plan, which is to quote-unquote rebalance the economy, which in the language of China means to try and get more domestic demand growth instead of getting growth largely from exports, trying to reduce capital intensity, trying to increase energy efficiency, and also trying to be environmentally more responsible. So they're trying to use this fiscal stimulus package to address many of the shortcomings that they've seen in their current pattern of production. So it's a very interesting exercise that we're seeing in China. What we're also seeing in Malaysia, and Thailand, and Indonesia, and perhaps a little bit even in the Philippines, is this idea of looking to domestic demand growth as trying to replace export growth, again through a reorientation of fiscal policy. But there, they have much less room for maneuverability because they're constrained by fiscal and debt sustainability concerns. But even so, I think what you said was exactly right, that there will be an effort to try and change the pattern of growth in these economies. But I still hold to the view that even if they change their patterns, the rest of the world, say 3 years down the road, is going to have savings which they're going to want to park and earn returns from. And there's a concern that this will all once again go to developing countries, and particularly to East Asian emerging economies.
You mentioned China. China's obviously a crucial country, both for its political presence and as a trading partner for Australia for exports and so on. I note today that Glenn Stevens said that China's economy recorded little GDP growth in the last quarter, but he says there are some tentative indications of a turn for the better in China, although it is too soon to know yet whether this will continue, although he does later say China's emergence has not finished. Is that how you read it as well? You think China's well placed? Or perhaps not as well placed as everyone thought, even at the start of this year?
China has an amazing capacity to mobilize all the institutions that it has for a particular end. What we've seen in the past has been this ability, but to deal with overheating, which has been the opposite problem. Now there's underheating, if you wish. But in the past, there have been several episodes of overheating. And China has always employed not just market levers, but also all kinds of administrative mechanisms to deal with that, and has done so remarkably successfully. This time around, we're seeing exactly the same sort of effort. The $586 billion package, for example, is only financed 1/3 by the government, by the central government. The rest of it is going to be financed by banks and by local governments, and under the direction, though, of the central government. Already in December and January, we've seen very rapid increases in credit expansion, purely driven by this concern to generate activity, especially in inland areas. So yes, I do believe that the Chinese have this sort of unique mix of institutions and policies and abilities which will allow them to deal with this crisis better than many other countries, which will only be able to rely solely on market levers which are going to have limited effects. There are some signs that things are beginning to bottom out, but I do believe that we're going to have to wait for much longer to see whether they're going to be sustained or not.
Mark, a quick point on that.
Yeah, I just wanted to pick up one thing on that, which I think has been fascinating to watch, and that was a couple of years ago, China watchers, not all of them, but quite a lot of them, spent a lot of time telling us that China was really pretty much becoming a market economy, and that we shouldn't stereotype it by saying it was still a state-controlled one. And a lot of the concerns that other countries had about it being a state-run economy were misplaced, and it was okay, for example, for Australia to recognise China as a market economy. We're now told that, in fact, the great hope for the world economy is that China isn't a market economy after all, that it's still essentially planned, state-controlled, not state-run economy. And the reason that we can be optimistic about China is because the government actually does have its hand on all the levers, can pull them, and China will come out of recession very quickly. And the interesting thing is that not everybody, but some people seem to be able to hold these two propositions in their head at the same time, which is fun. It's striking, and we actually have to hope, of course, that they're right on the second one. I think they probably are, but it's an interesting one. The other issue that I think is interesting is the relationship between China and Southeast Asia at the moment. We've been doing some work at this at the Lowy Institute, which started before the crisis, and there was this interesting debate about to what extent China could become a locomotive for regional growth, and to what extent was the trade that the rest of the region, including Southeast Asia, was sending into China was basically just for assembly and shipping out. And we've had an answer to that question already. It was that most of it was the through shipment. But the other issue that people were starting just to worry a little bit about was to what extent what happens if China, if you like, moves up the value chain and decides that instead of taking all those imports from Southeast Asia, bolting them together and shipping them out, it just says, well, actually, we can make all this stuff at home, guys. We don't need you anyway. So that engine of growth disappears too. A few people have started to say the really sharp falls in exports from the rest of the region to China compared to China's trade performance, which has been stronger, is a sign that that process of China doing more domestic value added at home is accelerated very quickly, and that adjustment the region's going to have to face is going to happen much more quickly.
Tim, quickly.
Yeah, I mean, even before the GFC, we knew that Beijing had made a deliberate effort to move from the coastal seaboard towns of Beijing, Shanghai and Guangzhou to the second and third tier cities in the west, so-called country towns of about 8 million people. And this has been quite a deliberate strategy. We knew that before the GFC, and I suspect that Mark's right, because they know that if they get growth numbers like they got last quarter, the social unrest will overwhelm them. So they have to do it.
We have another question, please. Yes, please.
Yes. I'm Temple Jones from Westpac Pacific Banking. Tim, I think you mentioned that the countries in Pacific, Fiji, PNG in particular, were important in terms of trade partners for us. How do you see the continuation of the global financial crisis actually falling out around those economies, and particularly for a country like Papua New Guinea, where for the last 12 months really has been riding off the back of a different effect on their economy because of some of the larger projects that are happening there?
Yeah, thanks for your question. I was just having a look at some of the trade numbers before I came in here, and in terms of businesses going to Papua New Guinea, almost as many Australian businesses export there as to China, and the same with Fiji and Japan. I think that there's two things that are important in PNG. One is obviously the regulatory regime for investment, and I think what the GFC will, on one hand, do is cause some, a reduction in the availability of credit if people have high risk premium, which has been some concern in the trade finance game. On the other hand, it actually increases the incentive to basically establish very strong institutionals to attract foreign direct investment. So I think for that reason, there'll be a stronger incentives to get policy settings right. Secondly, I think that a lot of the infrastructure projects that are occurring in PNG and throughout the Pacific, a lot of that will continue because there's a lot of fixed costs locked in. But one important thing, I think, with a lot of the activity that Simon Crean's been involved in forging new regional trade pacts is that the Pacific be an important part of that, as well as ASEAN and New Zealand. Thank you.
There was another question over here in the red shirt, I think.
Yes. My name is Eric. I'm from IFC. The price of commodities has come down a lot. My question is that since the government printing, all over the world printing lots of paper money into the system, whether we are expecting a sort of hyperinflation or stagflation year ahead of us.
Hyperinflation ahead of us, Mark. Is that a legitimate fear?
Not in the short term. I think short term the risks are all the other way. The risks are, if you look at some of the output gaps that are being projected, the risks are deflation rather than hyperinflation. I think there is a very interesting long-term question though for some countries, and when you think about the scale of fiscal stimulus that's going to be needed to close the output gaps, about what that's going to do, particularly to the countries that Vikram mentioned, which already have large-scale public sector debt, you're going to see that debt burden increase pretty sharply. And you're seeing that at a time where I suspect, at least in some countries, central bank independence is being compromised, partly because the aura of success and achievement that central banks had over the Great Moderation has been blown apart now. In several countries, people look and say, well, you guys are supposed to be overseeing our economies, you missed it. and partly just because as a result of the extraordinary measures that you start to have to take once you hit the zero bound, that in a sense brings more coordination with the government, more coordination with the Treasury, and that sort of compromise. If you add those things together, possibly compromise central bank independence or less kudos to central bankers, large debt burdens in some countries, and all of the unconventional money that's flushing in, then if you want to think about long-term risks to the world economy, then a resurgence inflation is probably a good one to worry about, but it's not what we need to worry about for a while, I don't think.
I know Tim's got something to say on that, but I'd like to get another couple of questions, please. Yes, sir.
Just like to introduce the other GFC, the global food crisis. It was at the forefront, I think, of a lot of people's minds before the financial crisis happened. And just to get the views of the panel on what implications a financial crisis has on the food crisis. Means of introduction, I'm Archie Law from Austria and Action Aid.
Vikram, maybe you could answer this.
Well, this is something that, in fact, the World Bank is looking at, because that's exactly what they are concerned about. That there might be the short-term effect on food, but there is a concern that over the next year or two, once again, food prices are going to start creeping up, because once sort of demand stabilizes and inventories are used up, then we might be back to the same concern earlier. But do remember that the last food crisis that occurred after a long period of very low food prices, and the trigger for the sharp increase really came from this remarkable, sort of unusual subsidy for ethanol production using corn in the United States, which took acreage out of normal food production and into alternative fuels, and that then triggered a series of sort of knock-on effects. For example, in India, when the price of wheat began to go up, they put in restraints on exports of rice because they were concerned about the import bill on wheat, and that led to an increase in the price of rice. So a lot of these things were sort of idiosyncratic. They were, and I think also over the last year or two, there has been a sharp reversal in agricultural policies of many countries to once again try and focus on improving production, bringing more areas under production and so forth. That's incidentally also contributed in part to the reduction in the price of many foods. But even so, I think pretty soon we might find that food in particular, not metal so much, and perhaps not even fuel, but food prices will start inching up again.
Got time for one more very quick question at the back, please.
Yeah, I'm Nigel Roberts from the World Bank here in Sydney, and I have another question on the smaller island developing nations of the Pacific. We know that to varying degrees these countries are all highly dependent on exports of commodities, on tourism receipts, and also on remittances from migrant labour, all of which would appear to be under threat at the current time. I wanted to ask the panel what they believe would be the most constructive policy response from the major aid donors to the Pacific.
Just got time for a quick sentence answer for this one. Maybe we can continue the discussion a bit later. But Tim.
Yeah, okay. I'll just answer the three questions together. Hyperinflation, no. But I was going to actually answer it because with the question on food, I think the biggest issue with the global food crisis is it climate or is it man-made through policy action? And I agree with Vikram, where it's climate, you can't do much about acts of God, but some man-made policy actions, export controls can exacerbate it. And with respect to the final question, I actually think this is a good opportunity to actually have reform in labour market and migration to actually make it easier for a lot of Pacific nations to have more mobility.
Mark, quick point? No, Vikram, quick point?
Well, just very quickly, I mean, Nigel is a colleague of mine, and I know exactly what's underlying his question. This is the latest in a series of crises that these countries have faced. I think the question we have to ask ourselves is, what needs to be done in the long term to try and make sure that these countries have the capability to deal with this problem, which keeps coming up in many ways, shapes, and forms. And while there might need to be some immediate actions, I think really the answer lies in putting in place some long-term arrangements to ensure resources are available to these countries to deal with this kind of issue which keeps popping up over and over again.
Great, lovely. Well, I'd like to say thank you very much to our panellists, to Vikram Nehru, to Mark Thirlwell, and to Tim Harcourt. Thank you for your time this afternoon. Tim Harcourt, his first ever article was published in The Diplomat, and the next issue of The Diplomat is on sale on the 2nd of March, so I hope you all get a copy of that. In the meantime, there's going to be another Praxis Roundtable next month, and in the meantime, thank you very much and goodbye. Thank you.
Thank you.